Have you ever looked at a company like NVDA, seen that its PE ratio is 73 and thought, wow, that is way too expensive, especially when the average PE ratio of the S&P 500 is around 15 or 16? While most people might think that this is expensive, let me show you the reasons why it might not be. Most people just calculate the PE ratio and stop right there. They might compare it to another company's PE or the S&P 500's average and think they've got it all figured out. But that's just scratching the surface. The real magic happens when you dig a little bit deeper. So let's break it down together. Let's connect the dots with 4 key terms: market capitalization, price, net income, and earnings per share, or EPS for short. Once you get how these are related, you'll see how they help in valuing a company. First, price. This is the price of one share of a company's stock, what you see on the ticker. Now, if you take that price and multiply it by the total number of shares a company has issued, you get market capitalization or market cap. This represents the total value the market places on the company. So for example, if a stock is priced at $50 and there are 1 million shares, the company's market cap is $50 million. Now let's talk about profit. A company's profit or net income divided by the number of shares give us earnings per share. So if the company's net income is $20 million and there are 1 million shares, the EPS is $20. Just like market cap shows the company's overall value, EPS tells us how much profit is attributed to each individual share. The cool part is, the same way you multiply the stock price by the number of shares to get the market cap, you can multiply the EPS by the number of shares to get the company's net income. Now let's link these concepts to the PE ratio. If you take the market cap and divide it by the net income, you get the PE ratio. This is the same as if you divide the price by the EPS, you still get the PE ratio. It's just 2 different ways of looking at the same relationship. Now here's something important. Market cap is the actual value of the company. The stock price is just a smaller, more digestible number to help investors understand on a per share basis. Always remember, market cap reflects the company's overall worth, while price is just one part of the equation. So what exactly is the PE ratio? The PE ratio stands for price to earnings, and it measures how much investors are willing to pay for each dollar of a company's earnings. Think of it as a quick way to gauge whether a stock is overvalued or undervalued, but it's not the whole story, so let's dig a little deeper. There are 2 main types of PE ratios, the trailing PE ratio and the forward PE ratio. The trailing PE ratio looks at the company's earnings over the past 12 months. It's backward looking, so it tells you what the company has done. The forward PE ratio, on the other hand, is based on the company's projected earnings for the next 12 months. It's forward-looking, so it's more about what investors expect the company to do in the future. One of the weaknesses of the trailing PE ratio is that it tells you what happened in the past. And in the stock market, what really matters is where the company is going. That's why the forward PE ratio can be so useful. It gives you insight into what analysts and investors expect. Let me share a quick story. Back on February 20th, NVIDIA's stock price was around $69.45. At the time, its trailing PE ratio was sky high at around 91. Most people would see that and think, whoa, this stock is way overpriced. But I've been investing in NVIDIA since 2017, so I knew that this kind of PE wasn't unusual for them, especially given their growth. The real insight was when I calculated their forward PE. I knew that they were about to announce the earnings with the next day with a projected EPS of 42 cents, which would bring their trailing 12-month EPS to $1.19 and lower their PE ratio to around 58. Seeing this and knowing their historical PE was much higher, I saw an opportunity. I sold off some shares of other stocks and bought more NVIDIA. And then I fast forward 6 months later, those shares had gone up over 50%. Not bad, right? The lesson here? Understanding the forward PE can give you an edge. It helps you see past what the stock has done and focus on where it's headed. But let's keep it real. No metric is perfect. A high PE could mean a company is overvalued, or it could mean investors are expecting really big things. A low PE ratio might mean it's undervalued, or it could also be a value trap, a stock that looks cheap, but it's actually on its way down. And then there's a negative PE ratio, which happens when a company isn't profitable. In these cases, the PE ratio isn't much help, and you might want to look at other metrics like the price to sales ratio. We'll dive into that in another video. So how do you use the PE ratio in your own investing? First, compare it to other companies in the same industry. Industry leaders often have higher PE ratio because they're expected to keep leading the pack. Also, compare the PE ratio of a company to its historical average. Is it higher or lower? Why? This context can tell you a lot. If the PE ratio is negative, don't panic. Just know that you might need to look at different metrics to get the full picture. That's it for today. Before we wrap up, I'd love to hear from you. Is there a stock you're curious about? Drop it in the comments and I might just analyze its PE ratio in the upcoming video. Let's dig into this together and make smarter investing decisions. Please note that I may have positions in the stocks discussed in this video. Do not buy or sell any securities based solely on what you hear in this video. Always do your own research or consult with a professional before making any investment decisions. Thanks for hanging out with me today. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more easy to understand and investing tips. See you in the next one.